How do you delta hedge a put option? If you are curious about how to delta hedge a put option, you are in the right place. Delta hedging is a strategy used in options trading to manage risk related to price changes of the underlying asset. Let's break down how this works specifically for put options. First, let's talk about delta. Delta measures how much the price of an option changes when the price of the underlying asset changes. For put options, delta is negative, which means that as the underlying asset's price goes up, the price of the put option goes down. Now, to delta hedge a put option, you need to offset its negative delta. This is done by taking a long position in the underlying asset. Here's how you can do that step by step. Start by calculating the delta of your put option. This value tells you how much the option's price will change for a 1-unit change in the underlying asset's price. For example, if your put option has a delta of negative 0.5, that means for every $1 increase in the underlying asset, the price of your put option will decrease by 50 cents. Next, determine how much of the underlying asset you need to buy to hedge your position. Multiply the number of put options you hold by the absolute value of the delta. If you have 100 put options with a delta of negative 0.5, you would need to buy 50 shares of the underlying asset. This is because 100 options multiplied by 0.5 equals 50 shares. The goal of delta hedging is to keep your overall delta at zero. This means that any price movement in the underlying asset should not significantly impact the value of your portfolio. As the price of the underlying asset changes, the delta of your put option will also change. This is where continuous adjustments come into play. You will need to monitor the delta and adjust your hedge by buying or selling more of the underlying asset to maintain that delta neutrality. Delta hedging can be particularly useful in volatile markets. It helps manage risk and stabilize returns. However, keep in mind that this strategy requires constant monitoring and adjustments, which can lead to higher transaction costs. In summary, to delta hedge a put option, calculate the delta, determine the hedge quantity, maintain delta neutrality, and make continuous adjustments. By following these steps, you can effectively manage your risk in options trading.